Hello, it's me again on The Week Ahead. This is where, of course, we take a look at what's in store for the markets this week, and we invite a special guest to take us through those key events. Well, joining me on the line is Michael van Dulken from Accendo Markets. First of all, Michael, what have we seen so far today in the markets that's caught your eye?
Yeah, unfortunately, we started this new week and a new month on a bit of a downer again, which relates to the continuing sway in sentiment regarding the US Fed's QE3 program and whether it will taper its intervention or not. And that follows, perversely, stronger than expected data last week, which, if anything, should be good for growth. But this just highlights how addicted markets are to easy monetary policy and how fearful they are that punch bowl, if you like, will be withdrawn sooner than expected. So that gave a negative lead for Asia overnight. We had some conflicting data from China regarding PMI manufacturing. The official figure was better than expected, showed a little bit of an improvement. However, the HSBC figure threw growth into question with a negative figure, although non-manufacturing official figure was actually okay. Other than that, this morning we've had some fairly decent Eurozone PMI manufacturing figures. In terms of, they're still pretty subdued and sub 50, but some of them were a little bit better than expected. And the UK did quite well with a better than expected figure and a revision to the prior month.
Michael, you mentioned the euro area just then. I'm sure it will once again be a focus this week, but what are your ones to watch, if you like, in the early part of the week over the next few days?
On Wednesday we've got the GDP figure for the Eurozone, which is going to be interesting in that it's unlikely to be much change in terms of the week, quarterly figure, and again still depressed on the year as in the quarter as Eurozone suffers under the weight of imposed austerity. But what is interesting, last week we had the Brussels kind of backtrack a little bit on how far they expect austerity to be pushed, because they are fearful that it is choking off any growth potential to bring the region into some form of recovery. So we had the deficit to GDP targets for certain countries pushed out quite a way to allow them a bit of breathing room, if you like. Other data, we've still got fairly subdued inflation within the Eurozone, so Tuesday's PPI figures are unlikely to change that. So that still gives the ECB a bit of wiggle room for rate cuts should it be necessary. But they're so low still that we don't see that being used as ammo just yet. And then we have the rate decision from the ECB on Thursday. Again, we've seen no change there. The 0.5% for the base rate, and deposit rate still at around zero. We still see the focus really being on the US data and non-farm payrolls at the end of the week.
Asia, obviously these days, tends to be a region that attracts attention when key data such as China's recent poor HSBC manufacturing numbers are released, as you mentioned a minute ago. But on Thursday this week, another growing Asian powerhouse, South Korea's latest GDP growth rate, will come out. The country's finance minister has recently expressed concern over Japan's monetary policy. Why is this, and what could be the repercussions to the markets?
The concern there will be in terms of exporting. South Korea is a big exporting powerhouse, and while all eyes are on China in terms of providing indications whether we have a global uptick or downtick in terms of growth, South Korea can be looked at to the same degree. They're big manufacturers of tech and autos. And I guess the intervention by the BOJ, so they're looking to weaken the currency and revive their flagging economy where it's deflationary and growth has been absent for a significant amount of time. I guess the concerns there potentially that there's, Japan is helping itself by making itself much more competitive in terms of exporting its own goods elsewhere in the world, and South Korea will see itself being shunned while the Japanese currency remains artificially weak.
Then, of course, this leads us to NFP Friday. I'm guessing market players are anticipating further good news from the US as far as economic data is concerned, or am I being too presumptuous?
It depends what you mean by good news. We have a serious trade-off at the moment between good news being good news in terms of growth and recovery, which should be what everybody's looking for. But good news also, especially in the US, can equate to removal of the Fed's QE3 program, which the recent rally in risk appetite has benefited so much from, that people are fearful that is being taken away too soon, and that there aren't enough signals of genuine underlying growth for that to be warranted. So, we could well have another replay of last Friday, where the very strong Chicago Fed and Uni of Michigan readings were taken initially nicely, but then the fear set in. Okay, Bernanke's going to see that as good data. He could well taper, and that could be taken badly by the market. So we've got a real trade-off between. Non-farm payrolls have seen around 170,000, which is similar to the ADP reading on Wednesday. If we get a good number, something around 200,000 would be nice to see. It is good, but it could be taken badly in terms of QE3. Whereas a bad number is not great for growth, but it is likely to appease those who are worried about QE3 tapering, because they would see that as warranting Bernanke staying put for a while. So it's very interesting times at the moment, and it really does depend on the interpretation. If anything, an inline number is probably the best in terms of limiting volatility.
Okay, that's all we've got time for, I'm afraid. I'll be back tomorrow to bring you the press review, but until then, enjoy your day. Goodbye.